If you want to know about property in Australia, you turn to Cotality. Joining us this week, very special guest, Head of Research, Tim Lawless, goes through state by state, the best performers, the worst performers, how we're still measuring household income to average property prices, and the best opportunities in 2026. Let's get into it. Welcome back to another episode of Your Wealth Playbook. We have a very special guest this week, the Head of Research at Cotality, formerly CoreLogic, Tim Lawless. Tim, thank you very much for joining us today.
Absolute pleasure, Jared. I'm glad to see you got the brand right. It's still kind of fresh. So a lot of people still call us CoreLogic, but yeah, Cotality is our new brand. But then again, some people still call us RP Data. So yeah, it's been quite the evolution.
Mate, it's hard to break habits when you're dealing with it 100 times a day, and it's such a core part of what you do. What was behind the change in name and branding?
Well, a lot of things. So for a bit of context, where the company's owned by private equity, so two very large US-based private equity firms, and over the past couple of years, we've had a lot of acquisitions, and globally, we've really moved from being a mortgage and finance style of property data company to something that's much broader and encompassing. That's always been the case here in Australia. We've always been, in real estate, banking and finance, government, insurance, valuations, pretty much everything. But definitely in the US, it's expanded a lot. So that the brand change is really just a reflection of that. A much more diverse business, which was really just trying to refresh the perception of the brand, I think.
Yep. Well, it's a household name in terms of everything that we deal with every day. Business as usual in terms of the back end.
Mate, same data, same insights, just a different name. So it's everything's the same. In fact, I think when you look at some of the investment going into just analytics and property data intelligence, not just here at Cotality, but everywhere. Yeah, we're seeing huge leaps forward in just, processing power, in the types of methodologies being used. AI, of course, becoming a lot more common. I mean, even though we've been using AI and more particularly machine learning for a long time in a lot of our algorithms and methodologies, particularly in automated valuations and that type of thing. But it's definitely becoming a lot more mainstream now, which simply means for people like you and me and your listeners, there's ongoing improvements in the quality of the data and the measurements.
Yeah, and we're certainly seeing a lot of that being picked up, especially by smaller lenders. The Big Four and Macquarie always been trailblazers in terms of their adoption, especially of automated valuations. But yeah, now seeing more and more in the smaller space with the high level of trust and the very high level of accuracy and intelligence that comes with those automated valuations that we see.
Yeah, absolutely. I think there's always going to be a place for human valuers, particularly when it comes to really unique properties and non-residential properties like hotels, golf courses, that type of thing. You can't really put an automated valuation on a home like John Simon's place overlooking Sydney Harbour and the Opera House, right? It's just impossible to really value through an algorithm. But for really homogeneous housing stock, an automated valuation works really well, and it's instant. That's why the banks really like it. They're generally pretty accurate, and they're really fast in this day and age where speed is so important, particularly for a bank or a lender. When you're looking at speed to yes, essentially from a home loan application, if you can get that application and the valuation in place really quickly and have confidence in it, then it just speeds up the whole process.
Yeah, absolutely. Now, Tim, current state of play, always one of my favorite areas whenever you talk at a professional development day. Today we are staring down the barrel of the potential fourth rate cut of 2025. Cash rate's currently sitting at 3.6%. With more priced in for next year, how are you seeing sentiment shift at the moment?
Well, we've definitely seen sentiment rise since rates have started to come down. Obviously, February was a real catalyst for all interest rates coming down, and that's aligned with sentiment improving. Confidence is clearly rising, but from a pretty low base. Jared, I mean, if you look at some of the measurements of consumer sentiment, there's two mainstream measures. There's a monthly measure from Westpac and the Melbourne Institute, and there's a weekly measure from ANZ and Roy Morgan. They both show very similar trends. they're not quite at sort of where optimists and pessimists are equally weighted in the market. It's still a little bit of pessimism in the market. Westpac's index, which is the monthly one, that's sitting from memory at about 95 now. So the magical number is 100. So at an index number of 100, that means you've got equal number of optimists and pessimists when it comes to the outlook for their finances and the economy and interest rates and inflation, all that sort of stuff. So, but a couple of years ago, we were seeing sentiment was way down in sort of the 60s. So it's definitely picked up, but there's still a few things that I think are keeping a lid on confidence. Most of them tend to be outside of our control, like the tariff announcement. Remember Liberation Day from Donald Trump? I mean, that sent a few shudders through confidence. We're still seeing a lot of global tension, that type of thing. So, yeah, I think with that in mind, sentiment hasn't really picked up as much as what you might have expected it to as GDP starts to rise and interest rates come down and cost of living pressures are kind of getting under control. We're still seeing sentiment in pessimistic territory, but yeah, the good news is it's definitely rising. I think it'll rise further from here. And of course, the implication for housing is there's a really close relationship between consumer confidence and housing activity, that they tend to move in the same, pretty much in parallel. So as we see confidence rising, we've definitely seen the same thing in housing markets. Values are lifting, demand is starting to come back into the marketplace as well.
Mm. Now, you said values rising. We saw values accelerate through winter this year. In terms of driving that, is that wholly and solely associated with the interest rate decline?
No, there's a few other things at play, and it's a really good reminder, I think, Jared. I mean, interest rates are really important for the housing market, but there's a whole bunch of other things that tend to influence housing trends. Just go back to, say, the period of macroprudential policies, which really limited housing credit. And then we had the Royal Commission, great example of how tighter credit conditions can really influence housing markets. There's also things like policy. We're about to move into October 1st. We see the expanded first home buyer deposit guarantee goes live. I think that'll probably have a bit of an inflection in first home buyer demand as well. Then there's other things like, global shocks can have a big impact, like the GFC. There's broadly sentiment, as we talked about as well. So, and then of course there's supply. So that's probably the biggest picture here is, even at a time when interest rates were really high, think back to early 2023, and the sentiment was generally pretty low, but starting to rise. Supply was also extraordinarily low, and it just ran headlong into a demand shock from overseas migration picking up and households becoming smaller. It's a really good example of how this mismatch between demand and supply has just supported growth in housing prices at a time when interest rates have been high and confidence has generally been pretty low.
Mm. Now, talking about supply and demand and the government's tracking of 1.2 million new properties being built, when does this pipeline of supply meaningfully uplift? And when are we hoping to see that? Obviously, at the moment, we're well behind where we want those numbers to be, and net migration over the last 2 years in particular, making up for the COVID period, has been enormous. Are we going to see issues with that being so far behind?
It's a real challenge, mate, and it's a hard question to answer. I mean, there's a lot of focus on trying to get more supply into the market, but the reality is you can have policy objectives, the 1.2 million well-located homes by the middle of 2029 is the target. We're not going to get there. We're not going to get close to that. Most economists and analysts think, well, we might get up to sort of the high 900s at that stage. So the reason we're not going to get there is simply the private sector, the market delivers supply to the marketplace, and it's unfeasible to do so at the moment. The construction costs are very high. We've got a labour force that's extraordinarily tight for construction trades. There's a huge amount of competition with big infrastructure projects that generally are attracting more of that skilled labour because they pay well. They generally have long tenure arrangements. Heavily unionized as well, the government contracts. So I think with that in mind, we have seen some uplift in approvals. So the really early stage of new supply, you look for approvals. That's risen from a low base, but only to about the 10-year average, and it's holding around that 10-year average. So to get to that 1.2 million homes target in 5 years, we need to be seeing about 20,000 approvals a month. We're not close to that. We're seeing around 17, 18,000. And cumulatively, as you miss the target every month, it just gets bigger and bigger to catch up. The other thing is, approvals are one thing, but we've already got a lot of stock in the pipeline as well that have gone through the approval process, that have actually commenced, but haven't completed. And this is a real reflection of just the feasibility challenges I was talking about. It's taking longer to deliver homes. The typical apartment, in terms of delivering it to the marketplace, uh, it used to be about 18 months to build. Now it's about 28 months from a commencement to a completion. It's a real reflection of just the challenges the builders are facing. Then on top of that, we've also seen a huge amount of builders have actually just faced liquidity pressures, which means they've gone insolvent. So if you look at the ASIC insolvency data, about a quarter of all insolvencies across the country are in the residential construction sector, which is quite elevated, and it looks like that's peaking out now, but it's still holding quite high. So there's so many challenges in the supply sector, and fair enough. It's good to have a stretch target like the 1.2 million number, but the reality is we're not going to get there, and the impact on housing markets simply means that there's undersupply of newly built homes that's been with us for some time now isn't going to be addressed adequately for at least a couple of years, I would think. Infrastructure Australia doesn't think we'll see sort of a peak in infrastructure activity and a crossover of supply and demand of workers until about 2028. And that's when we'll start to see, hopefully, a little bit of labour being freed up to focus more on residential construction.
Now, with not hitting those sort of targets and the supply not being there, is there any concern that you've got with the changes to the first home buyer schemes coming in next week, and in terms of particularly capitals?
Yeah, I mean, this is a pure demand side stimulus, right? It does nothing to address the underlying reason why we need to give first home buyers a leg up into the marketplace, which is affordability. So yeah, the unfortunate reality is, first home buyers, I think, will be quite. We're expecting to see demand rise as first home buyers take advantage of the 5% deposit guarantee. It's a great way to get your foot in the door of the market. So I think it'll be quite popular. But on the flip side, it's just going to drive prices higher. It doesn't really fix the underlying problem. It just kicks the can down the road a little bit. And for, say, first home buyers a year or two from now, it's going to be even harder. And I think you could also look at other things. I mean, there's a lot of discussions around responsible lending standards and prudential policies. A 5% deposit is a really small deposit. It generally means it's a riskier type of loan. It means for a first home buyer, their time frame to pay that off is going to be longer. But of course, if you're getting into the market earlier, it means you're saving on rent and you're probably building some wealth through hopefully some capital gains in the market. But yeah, it doesn't really address the underlying supply. So I think the first home buyer deposit guarantee, remember, it's now no longer doesn't have any caps in terms of incomes. It doesn't have any limits in terms of the number of places, and the price caps have been lifted massively as well. So in Sydney, it's up to 1.5 million. In Brisbane, it's 1 million. So that really does open up the opportunities and the choice for first home buyers to get into the market. But I think the most desirable areas are probably going to exceed the price caps really quickly. So it probably will be a case of first in, best dressed. And then gradually you'll find, particularly for detached houses, a lot of suburbs just exceed those price caps, and first home buyers' demand will simply just ripple further and further out from the city where prices are a bit lower, or maybe towards the apartment sector, which you can almost take your pick for suburbs that fit the price caps for apartments, unless you're looking at like the eastern suburbs or the inner west or lower north shore in Sydney, for example.
Mm. And then, of course, you've got the investors. They're going to be battling them for the same type of properties in the same blue chip locations, and the fire that then incites between the two, just driving up demand from both sides at that point in time.
Good point. Really good point. I think in first home buyers and investors quite often play on the same footy field, if you like that. Typically around the median price. So yeah, and investors are pretty active, right? So 37% of mortgage demand is going towards investment loans at the moment. Long-term average is about 33%. So investors are quite elevated. And investors chase capital gain, and areas that are likely to be most popular with first home buyers are probably going to be seeing some stronger capital gains as well. So, yeah, I agree with you, mate. It's going to be quite competitive and maybe a sense of urgency quite early in the piece.
Now, looking at borrowing capacity, particularly around those first home buyers and investors, post rate cut, how much have you seen this bounce, and how much do you foresee this continuing as we sort of go down the next 12 to 18 months of continued rate cuts?
Yeah, so I mean, if you look, there's a whole bunch of ways you can work this out, and just jump online and you can use any number of calculators. There's some really rough numbers. Say if you're on a household income of say $250,000, interest rates back when they were sort of at their peak. So for a variable interest rate, they were peaked at about 6.4%. That meant your borrowing capacity on 250,000, not taking into account expenses and debt levels and all that sort of stuff, right? So everyone's got their own unique situation. That meant you could probably borrow about 1.23 million on a $250,000 household income, right? So rates are down on average now to about 5.5%. Just looking at variable rates for outstanding loans, that means your typical borrowing capacity is about 1.33 million. So in sort of just looking at the difference between the two, you've got about a 98,000, pretty much $100,000 difference in borrowing capacity. But the other thing is, of course, interest rates have come down, but also prices have risen. So since February, we've seen in a national index, housing prices are up about 32,000. So that nearly $100,000 improvement in borrowing capacity has already been eroded by about 30%, given the fact that prices have risen as well. So your money doesn't go as far.
Now, arrears has been ticking up, still in a declining interest rate environment, still remain low. And now the 30-day conforming mortgage arrears rose by 23 basis points in the quarter on quarter just gone. Are there any signs or stresses in particular pockets that are concerning?
Yeah, I mean, there's definitely areas where arrears are a little bit higher, but it's fair to say, like an overall arrears rate that's about 1.6% when you include non-performing loans as well as shorter-term arrears. That's pretty low in the grand scheme of things, given the fact that we've been through a cost of living crisis and we've seen, interest rates have done what they've done. They've gone from basically nothing to the cash rate of 4.35%, and now they're coming down. Yet we've seen the household sector pretty resilient. Borrowers have drawn down on their savings. You've got to probably look at prudential standards being pretty conservative and quite risk averse as another reason why arrears haven't risen very much. But yeah, there are some pockets, and so the pockets of risk, or the pockets where arrears are a little bit higher, tend to be your usual suspects. So loans where, say, the loan to valuation ratio has been higher, where they haven't had as much buffer. That's where we've seen arrears a little bit higher, but still only a little bit above 2%. Or in borrowers that have had a high debt to income ratio as well, have been a little bit higher. I'm just quoting some data here from the Reserve Bank, which they put out in their financial stability review. If anyone in your listeners wants to really have a deep dive into sort of banking arrears, it's a great publication to tune into every 6 months. There's also a few geographical areas where arrears have been a bit higher, like Melbourne is a good example. It's a market that's been a little bit softer for value growth. Values are still down about 3% on their record highs at the end of August as well. So that's the other thing. I think markets that haven't seen as much value growth means some borrowers don't have as much of an equity buffer as well. There's a really cool study by the Reserve Bank. This is probably 5 or 6 years ago now, called the double trigger hypothesis for mortgage arrears. And it basically said that for arrears to rise substantially, you'd really need two things to happen. You'd need unemployment to rise quite substantially, getting up towards 10%. And you'd also need housing prices to drop quite substantially, which means you'd have a much broader base of negative equity. At the moment, we've got unemployment that's, for 4.2%. We've got the RBA estimating negative equity at less than 1% of all loans and declining as well. So there's pretty small risk, I think, that arrears rates are going to rise further from here. I think they've probably peaked out. And I wouldn't be surprised as you see rates coming down and the cost of living pressures behind us to some extent, we probably will see arrears improving a little bit further from here.
I think you're spot on in terms of how resilient we were, especially through 23, 24, in the face of, very high rate environment in a very short period of time. something interesting you said there is, particularly an area of concern would be small equity levels. Coupling on to the changes with the first home buyer guarantee scheme, through a declining rate environment, you would usually think that things are going to get a bit easier and it's a good time to enter the market. If we were to experience an uplift in rates, say in the next 24 to 36 months, do you think a lot of those scheme loans would potentially be at a higher risk at that period of time?
Well, like I said, if you have a higher loan to valuation ratio or debt to income ratio, something like that, then absolutely you're at greater risk. It probably also means if you're a recent buyer in the market, you haven't had a chance to build up an equity buffer or a savings buffer as well. I think the risk of rates rising is a pretty small one, so that there's that. And also, there's no real evidence that first home buyers tend to be a riskier cohort in the marketplace. They do tend to be quite motivated, and for a lot of Australians, getting behind in your mortgage repayments is kind of like the last thing you tend to sacrifice other areas of your lifestyle and 2-minute noodles rather than getting late on your mortgage. So I think with that in mind, I wouldn't be surprised if even if rates did rise on a really unlikely situation, if we'd be seeing arrears pushing higher. The other thing to consider as well is even though the government's offering this 5% deposit guarantee, borrowers still need to get a loan. They still need to be qualified from a serviceability perspective. So the prudential standards still apply, and they need to demonstrate an ability to service the loan 3 percentage points higher than the going mortgage rate. Right? That's still the mortgage serviceability buffer is still in place. It might eventually drop back to say 2.5 percentage points or something like that, like it used to be. But that's still a pretty decent buffer. I'd be very surprised if rates did rise. That alone, I'd be surprised about. But if they increase, say 2.5 percentage points, something's gone quite awry, hasn't it?
Yeah.
So.
And look, you'd also hope that a lot of those first home buyers, they're at the infancy of their professional career as well. So to combat any of that, they've hopefully got increasing incomes, and like you said, worst case scenario, they can always cut back to 2-minute noodles as well to hold on tight.
Yeah, I don't know if anybody remembers the old Westpac versus ASIC legal case, which was a legal case about serviceability checking. But anyway, the judge basically said a classic statement of, you could enjoy the finest Wagyu and Shiraz, but if you need to cut back on it, then obviously you can, and you can rein in your cost of living expenses. So it's a great analogy, I think, on how you can sort of sacrifice other areas of your expenditure if you really need to.
Yeah, spot on. Now, Tim, one of my favourite topics you always talk about so passionately is your around the grounds of state and capital performances. What states and capitals are we looking to watch at the tail end of 2025 and into 2026?
Yeah, mate, there's a real range. I think it's fair to say pretty much every market is rising in value now. Even some of the weaker markets like Hobart have moved back into growth to some extent, Melbourne as well. But we're still seeing Perth and Brisbane really leading the charge. I had a quick peek at our daily index. If anybody's interested in looking at that, you can just look at our website. It's exactly the same as our monthly index. We just run it daily. So it gives you a bit of a feel for where the month's going to end. Looking at those numbers, the capital city index was up 0.9% over the past month, or the rolling 4 weeks, gives you a bit of a proxy. So that's a pretty decent step up from where it was at the end of August. End of August was up 0.7. So we're definitely still seeing the market accelerating. When you look below the surface, though, Perth is up 1.5% over the past 4 weeks. So this is a market that's once again really starting to break from the pack in a strong way. Brisbane as well seems to be under a pretty strong growth charge as well. The last month up 1.1%. Then you've got Adelaide and Sydney both up 0.8. Melbourne's up 0.5. So we are seeing a little bit of a repeat performance of what we're seeing through 2023 and 24, where it was those mid-sized capitals really leading the charge. Adelaide's definitely dropped back a bit. And if I was to look at any of those three mid-sized capitals and think about which one was riskier, Adelaide absolutely stands out to me. It's become extraordinarily unaffordable when you adjust for local incomes. and it's lost its interstate migration. That's now been negative for more than a year now. Overseas migration slowing, of course. It's really just being held up by really low supply levels, which ultimately are going to change at some stage. Brisbane and Perth seem to have stronger underlying fundamentals. Even though Perth has seen so much growth over the past 5 years, it's up more than 90% in value. It's from a really low base. It came into this growth run after a long running slowdown post mining boom. So it's still kind of middle of the pack when it comes to affordability. It's probably got some further legs. Brisbane's, it's got a huge amount of population growth, huge infrastructure projects leading into the Olympics, very popular with investors. So they're probably the two markets I'd be watching, for at least the mainstream markets, for further growth and outperformance. Darwin, even though it's a small market and it's highly volatile, that's running its own race. It's just, we're seeing value growth extreme at the moment there. Yields are really high, up above 6% gross. A lot of investment activity in Darwin at the moment, so quite a turnaround. But again, it's a small, fickle market that's generally driven by investment activity and big infrastructure projects. Then at the other end of the spectrum, I mean, Melbourne, I think Melbourne would be my medium-term pick for outperformance. It's still underperforming at the moment, but we haven't seen a gap this wide between Sydney and Melbourne since about 1999 in terms of the median value. It's a market that I think is now undervalued. It's just moving back into positive interstate migration growth now. But that affordability advantage, as well as it's a reasonable economy, definitely not shooting the lights out, massive levels of government debt in Victoria, and higher property taxes as well are certainly a disincentive. But I think the fact that it's so affordable compared to, say, Sydney and Brisbane now is a real attractive point for Melbourne. Regional markets as well, can't forget those. I mean, they're underperforming at the moment compared to the capitals. Not that value growth is starting to slide. It's just the fact that capital cities are accelerating into this cycle. Regional markets have had their run and seem to be holding pretty firm at a sort of 0.5, 0.6% growth rate. But it's not the usual suspects that are really supporting regional markets. It's some of your more far-flung areas like Townsville, Mackay, Rockhampton in Queensland, Geraldton in WA. Albany's been pretty strong as well. Some of the more commutable markets like Ballarat are starting to pick up again. Ballarat's been extraordinarily weak. Values are down about 15%, but it's finally starting to grow again. Newcastle, Geelong, Wollongong, all those satellite cities, I think, longer term are going to be strong markets, given the fact that so many more people can work remotely, and the sort of hybrid working arrangements, I think, are quite permanent now, making those cities quite attractive.
And especially from an investment standpoint, barriers for entry are a lot lower. Traditionally, you've got your higher yields as well, and especially with investors that are looking for properties that are closer to neutrally geared in terms of strategies of using special purpose vehicles to accelerate their wealth building strategies. I think those regional towns have gone and will continue to stay in vogue for a very long time.
Yeah, absolutely. I'd still be a little bit cautious of some of the more, single industry towns. You can see what's happening with the coal mining industry at the moment, particularly in Queensland, is seeing a bit of a shock at the moment. A lot of mines closing, royalties very high, and just the profitability isn't there. So, areas like Mackay, which I just mentioned, are quite strong. You'd have to think that the shock to the coal industry isn't going to be a good thing for those sort of markets. So yeah, I'd definitely be looking at regional markets that had a much more diverse economy, that have strong population growth, maybe a lifestyle element to them as well, or just strong diversity in their underlying economy, from agriculture to government services, tourism, that type of thing. It's always looking for that blend of economic factors.
Yeah. Now, Perth, you mentioned again. Are you surprised at the continual outperformance of Perth and how it's still trucking along, given how well it's done?
A little bit. Yeah, I wouldn't say I'm not shocked by it. I mean, like I said, it's come from a really low base, and it's not all that unaffordable, despite the fact that we've seen values rise. They've nearly doubled in 5 years. But, you look at, say, a dwelling value to income ratio, which is a pretty good benchmark for looking at affordability across the markets. Perth's about middle of the pack. It's well below Adelaide in terms of its affordability, in a good way. Still got strong interstate migration. That's slowed down a little bit, but it's still very strong. Overseas migration has slowed as well, but that's holding back to sort of pre-pandemic levels, if not a bit higher. Supply is extraordinarily low in that market as well. So all the underlying fundamentals look reasonably okay to me in Perth. Like you wouldn't expect that market to continue a growth rate that's sort of 1.5 to 2% for much longer. That's clearly unsustainable. But yeah, I wouldn't be surprised if Perth does outperform most other markets, at least over the next 12 months, maybe a bit longer than that. But again, my words of warning to mining towns, they don't really apply to Perth. It does have a diverse economy, but obviously it is quite linked to commodities and the commodity cycle, and that seems to be a little bit more cautious at the moment.
Yeah. Now, houses and units and the value gap there. What are you seeing in particular across the capitals there, and is that gap continuing to widen?
So this is probably the more surprising component of housing markets, is the fact that that gap has widened to record levels. There's just on our national numbers, it's about a 33% difference between the median house value and the median unit value. That's a record high. Some markets like Sydney are more than 70% difference between house and unit values. Some markets have seen the gap diminish now, like Brisbane, for example. Go back, say, 4 years ago, Brisbane had the biggest gap between house and unit values, and now that's really compressed because units are quite strong in that market. But overall, when you look across, say, the combined capitals, houses are definitely outperforming units. They have over the short term, absolutely over the long term. You can see that the underlying growth rates are really driven by the value of land rather than the actual property that's on the land. The other thing about the apartment sector is, particularly in the really big markets like Sydney and Melbourne, apartment supply has been really quite lumpy. So leading into 2020, there was a real surge in high density development in those two markets. Well, Brisbane as well. And that's had a real hangover effect. So you can look at some of the really high density markets, like in Melbourne, it's the CBD, South Bank, Docklands, Port, are really good examples where values haven't really done anything. They've gone backwards, in fact, since 2017, 2018. You can still buy high-rise apartments in those markets, generally for less than what the owners originally paid for them. Parramatta in Sydney is another good example of one of those high-rise apartment markets that really saw a massive influx of high-density supply. And if you look at our pain and gain report, which looks at resales, absolutely, those high-density precincts are markets that really stand out for loss-making sales as well. The area for the unit market that's really been a lot more resilient has generally been the more established market, close, like in your inner city fringe markets, not necessarily high-rise areas, more areas that are more sort of more predominant with 70s, 80s style walk-up apartments that generally have much higher demand, lower body corporate fees, less maintenance problems as well. I mean, a great example will be somewhere like in inner Melbourne, Richmond, South Yarra, Prahran. Those sort of markets have actually been bucking the trend and seem to be quite popular with investors. Good yields, decent returns, and I think that'll be the case going forward. I'd still be a little bit wary of high-rise precincts. Good rental returns. They're generally quite popular with renters, but not a great option for medium to long-term capital gain.
Now, if you were to name the single most important chart that you're looking at this spring, what would it be?
Definitely the listing numbers, mate. Spring's highly seasonal for supply, advertised supply levels. I know we talked about supply earlier in the podcast, more about new building, which is undersupplied. I think a much more important factor to track for just more immediacy in property trends is listing numbers. It's immediate supply, it's available supply. And absolutely, we're seeing listings rising into spring like they always do. So there's more flow of stock coming into the market, but it's from a really low base and it's still lower than a year ago. It's kind of like pretty much bang on the 5-year average at the moment for the amount of fresh stock being added to the market, but it's being absorbed really quickly. When you look at the difference between new listings being added to the market and total supply, New listings are rising, but the total supply levels are holding really firm and really low as well. So total listings are about 20% below average nationally. Some markets like Perth is about 40% below average for this time of the year. Brisbane and Adelaide are sort of 20 to 30% below average. Even some of the markets that had seen supply quite high, like Hobart, is now below average. So is Melbourne. So that's probably the key thing to watch is that underlying listing supply, does it hold really low like that through spring? It looks like it's passing the test of the depth of demand at the moment. But if we did start to see total supply levels rising, total listing numbers rising, that's a pretty clear sign that demand just isn't keeping up to date or isn't keeping pace with the flow of new listings. Not seeing it at the moment. Clearance rates are up at, just looking at the finalized numbers this week, they're sort of 72%. That's the highest we've seen since 23. We're seeing time on market coming down a little bit. Vendor discounting rates, which measure negotiation in the market, they're tightening a little bit as well. So I think it's definitely a seller's market across most areas. That means for buyers, there's a little bit of urgency in their decision making. Definitely encourage buyers to make sure they've got their finances in place before they're actively engaging with the market, because once they find the property that's good for them, that fits all their criteria, they probably want to act pretty quickly on it, because there's a good chance someone will buy it out from under them if they're not getting in fast.
I think that's some great advice there, Tim. Couldn't agree more so. Now, you sort of touched on it before, but what city is most at risk of underperforming in quarter four, in your opinion? And what one do you think has the strongest tailwinds?
Yeah, I did call that Adelaide. I don't think it's going to be an underperformer in Q4. It's still rising in value, just not as quickly as it used to be. Melbourne, of the major capitals, is still lagging as well. But like I said, I think you really need to look at property over longer term performance cycle. I think Melbourne's definitely got some legs over the longer term. In Q4, I think Hobart's probably still going to be the weakest market, even though it's kind of edging back into growth. It's nothing to write home about. So across the capitals, I'd say Hobart is probably still going to remain the weakest market, maybe eking out a little bit of growth in inflation-adjusted terms, probably negative. But beyond that, I think more the medium-term outlook, I'd be looking for Melbourne to sort of pick up a little bit more than what it has. Adelaide to probably slow down a little bit more than what it's already showing. Sydney, it's hard to really see that market ramping up significantly given the affordability constraints that are so clear in that marketplace, as well as the fact that we're still seeing ongoing negative interstate migration, the slowdown in overseas population growth. Eventually, there'll be a supply response in most markets. We're definitely not seeing it in New South Wales. That's maybe the other wild card is we've definitely seen a little bit more supply being built in WA and South Australia. There are two markets where you can clearly see commencements are trending higher, particularly for houses. So maybe that underlying supply is finally being addressed in a couple of markets as well.
Now, what do you see as the best case for the next 90 days in terms of clearance rates, post-rate cuts?
Yeah, I don't think they'll be getting a lot above where they are at the moment. So, shooting the lights out is a clearance rate getting up around 80%, for example. And we were seeing that through the height of the pandemic growth trends, but value growth was extreme and supply levels are even lower than they are now. So holding above 70%, I think, is a pretty good outcome. And seeing clearance rates holding sort of 70 to 73% is my expectation through spring. Again, I think that's really going to be underpinned by really low advertised supply levels. Even though new listings are picking up, it looks like demand is keeping pace. If we do see another rate cut, I know we didn't touch too much about it, the outlook for rates, but it does look like financial markets are now only pricing in one more, probably in March of next year rather than the end of this year. It looks like economists are kind of pulling back a little bit on their rate cut expectations, given a stronger than expected GDP number, the fact that inflation on the monthly inflation indicator came out yesterday, that's picked up a little bit, mostly because energy rebates doing some expiring. So yeah, I think by end of spring, coming into early summer, we probably will see clearance rates holding around that sort of low 70% mark, but not getting up to where they were sort of through the pandemic.
Now, you mentioned GDP there. Underreported was when allowed for net migration, we actually had 6 to 7 quarters in a row of negative GDP without adjustment for migration. Was that an area of concern, or do we think that it had any part to play in the last couple of years? Is it a
Yeah,
concern moving forward?
mate, it's a really important indicator. So GDP per capita is arguably a better reflection of the economy than just headline GDP numbers. And as you say, Jared, I mean, GDP per capita has been negative for nearly 2 years. It just edged into positive on the June quarter numbers, so that's a good sign. And that's mostly driven by, well, uh, sure, overseas migration slowing down, so less population growth, but also consumption. Like people like you and me going out and buying stuff has really started to pick up. And I think that's probably why, that's definitely why we've seen GDP a bit stronger than what most economists were expecting, is that consumption spending has picked up a little bit more strongly than what most had expected it would. So I think that's a combination of just real incomes are rising. If you look at wages growth, adjusting for inflation, that's now the highest it's been since 2020, which is a great thing. So households are probably feeling a little bit wealthier. We talked about confidence rising. That flows into confidence to make purchase decisions as well. Inflation still is it's not like prices are coming down, but cost of living pressures I think are not as bad as they used to be either. So all those things have added up to see the economy moving from being one that's very much been supported by government spending and population growth to one that's now kind of inflecting where government spending slowing down and private sector consumption is starting to pick up. That's the logical scenario. That's how most economists would expect lower interest rates to sort of support economic improvements. But it's happened a little bit more strongly for consumption than we're expecting. So that's why we've seen just calls for rate cuts just pull back a little bit. A bit of a loosening in labour markets as well. That certainly helps to bring rates down. Everyone wants a job, but a tighter than what the RBA wants labour market kind of implies stronger wages growth, which then possibly feeds into inflation as well.
Now, Tim, if you were to summarize just one thing that a buyer should be doing differently moving into quarter four, and one thing a seller should be doing differently to attract the right, first of all, to secure the right property, but also to secure the right purchaser, what would your advice be there?
Mate, really frankly, I don't know, to be honest. So I think, well, hopefully most buyers these days are doing their research. That's generally what I'd say for buyers. Know the market you're buying into, know it intimately, right? It's one thing understanding the macro trends and stuff like that, but you really need to understand, the suburb level dynamic, even the street level dynamic of where you're looking to buy. So really drilling down and looking at comparable sales, what's on the market, getting to know the local real estate professionals really well. I think that's absolutely critical. And it's a lot easier to do now than it was, say, 10 years ago. There's a lot more tools and data sets available to make sure you're really informed about the market. So probably that's the number one thing I'd say for buyers is be an absolute expert on the market. This is going to be one of the biggest decisions you're making in your life, financial decisions at least. So you want to make sure you're researching it adequately, but don't get stuck in this analysis paralysis. That's probably the flip side here is a lot of people kind of just, they don't know when to stop their research. You've got to kind of make a decision. You're going to buy in this sort of area. This is my budget. Okay, I know everything about how much I should be paying. Bang, do the deal. And like I said before, make sure your finances in place as well. It's if you find the house and suddenly find you can't borrow to buy that home, you've wasted a lot of time. For sellers, like I said, it's a seller's market. So, in a market where it's harder to sell, you really want to be making sure you're standing out from the competition. But in this market, I think, making sure that your marketing campaign is really good. I think that's a hygiene factor. Looking for a really good real estate agent is really good. But I think for sellers, they're really in the driver's seat at the moment. So, I mean, if you're trying to overprice your property, it's going to sit on the market for a long time. So that's probably the most important thing is don't try to, overinflate your expectations on what you're going to get for your property. Get a good agent, rely on their advice, and I think make sure you're making the best of your selling approach. Get it styled. Make sure the photos are really good, have a good agent, have a good advertising campaign. That's always the case, I think, regardless of what the market's doing.
I think styling, especially over the last 5 years, has gone through the roof in terms of return on investment that people see for it to create that emotional attachment. And I think we're
Right.
continuing to see it.
Yeah, it's worthwhile. It's a worthwhile expenditure. Like it looks expensive on paper, but it probably means you'll be getting a higher sale price for your property because people will fall in love with it.
Yeah, absolutely. Absolutely. Well, Tim Lawless, it's been an absolute pleasure. Thank you so much for your time. I'd say you're the best voice in property in Australia, and we really do appreciate you coming onto Your Wealth Playbook today.
Many thanks, Jared, and I really appreciate the invitation to come on, and wish you all the best.
Thanks for tuning in to another episode of Your Wealth Playbook. If you could help us out in any way, the biggest benefit that Jared and I, and also Danny, will get is if you can subscribe to this podcast on your favorite platform and maybe share it. Send it to somebody that will benefit. You'll help us. If you'd like to help us, we'd love for you to help us.
The information in this podcast is general and does not consider your personal objectives, financial situation, or needs. Before making financial decisions, consider whether it is appropriate for you and seek professional advice. Past performance is not a reliable indicator of future results. If you would like to discuss today's topic further, reach out and we would love to help.
Jared and I have not assessed your individual circumstances. Therefore, this podcast is general in nature and for informational purposes only. This is not personal financial advice. There are so many advisors and brokers in Australia. You'll find one that you resonate with, but this is for informational purposes only. Or maybe just use Jared and I.